Hi everybody, welcome back to the 10th of an hour with Griffin Bridgers. Today's episode, episode 19, is very helpful if you or a client is looking at making any large lifetime gifts. What we're going to cover today is the estate tax anti-clawback credit, which is designed to keep you from getting dinged for making lifetime gifts if the exclusion amount, which offsets potential estate and gift taxes, goes down. So we're going to look at a newly published Treasury regulation from late 2019 that covers how to calculate this credit. But before we look at the how, we'll look at the why this was put into place. So to start with, everybody has an estate tax basic exclusion amount which covers gift taxes and estate taxes cumulatively in the form of a tax credit known as the applicable credit amount. Now that exclusion is currently a base of $10 million under the Tax Cuts and Jobs Act of 2017, and it's indexed for inflation. So for 2020, that exclusion with inflation adjustments is 11.58 million. Now the problem is that that is set to be reduced in the future. There's a sunset in the Tax Cuts and Jobs Act that says as of January 1, 2026, the base of that basic exclusion amount will be reduced to $5 million indexed for inflation. Now, it's impossible to know what the inflation adjustments will be at that time, but estimates show that the exclusion could go down to about 6.8 million based on examples in this Treasury regulation in 2026. Now, more importantly, it's an election year with a lot going on in the world and a lot of need for tax revenue. So there's many Democratic proposals which include an earlier reduction of the exclusion for estate and or gift tax purposes. Now the problem is if that exclusion goes down, if you use up your 11.58 million now, obviously, you're not going to have any left at death to cover estate taxes, especially if the exclusion is reduced. But the way that the estate tax calculation is set up, this exclusion applies as a credit against tax on both your taxable estate and your adjusted taxable gifts. So because of that, there's a risk that the IRS could claw back in the form of estate taxes some gift tax that would have been paid on gifts during life had the lower exclusion applied at the time. To prevent that, there's been a provision in the code for about 9 years now, 2001 G2, which prevents the clawback of gift or estate taxes at death, and the newly published regulations address how this works. So what this credit does is tying into the gift taxes paid credit that we looked at in episode 16. First, if you've ever paid gift taxes out of pocket, obviously you get a credit for those based on the rates applicable at the time of your death, as we previously discussed. But for gifts that were made during life, for which there was no gift tax paid out of pocket due to the use of a higher exclusion at the time, you'll get a credit for that higher exclusion that applied at the time of the gifts as well. Now, the amount of the exclusion is going to be based on the gift taxes or the gift tax rates that are available at the time of your death. So if the rates go down, it's possible that the exclusion amount that you get a credit for here will be lower than the exclusion amount that applied at the time of the gift. But either way, it should still cover a lot of the potential tax liability that could otherwise be incurred. So for a quick example, we're going to assume that there was a taxable gift of 11.58 million in 2020, and no other lifetime gifts have been made. So note that the term taxable gift assumes that any gift tax exclusions or annual exclusions have been subtracted. That gift tax annual exclusion is $15,000 per donee in 2020. We're also going to assume that the taxpayer dies in 2026 when the exclusion is only 6.8 million. Now, without the credit that we're going to talk about, the risk is that you now have 6.8 million in exclusion to offset the taxable estate plus adjusted taxable gifts of 11.58 million. So what the letter of the law in the traditional calculation means is that the estate tax base would have an additional 4.78 million gift that was already technically subject to estate tax or gift tax that was offset by the exclusion. This is where the credit comes in. There's now an estate tax credit that's calculated based on the exclusion that applied in the last year of the taxable gifts. So in this case, you'd calculate your applicable estate tax credit based on an exclusion of 11.58 million instead of an exclusion of 6.8 million. Now, if the lifetime taxable gifts had been less than 11.58 million, you would only use the exclusion that was available to offset tax on the gifts at the time based on the gift tax rates that apply in the year of your death. And keep in mind, again, this is only applying to gifts where you didn't pay any gift tax out of pocket. Instead, this applies only to gifts for which the gift tax was completely offset by the exclusion amount which was applied as applicable credit. So the big takeaway here is that there's now a little more safety in using your full 11.58 million exclusion for making tax-free gifts during life. So it's a truly use it or lose it proposition. Now the problem is that some people may not want to give away 11.58 million in wealth because what you have to do is permanently give it away to other people, and there's nothing you can do to take that wealth back in order to make a completed gift. Now, some practitioners have advocated making gifts to a trust in which the grantor could retain some sort of income interest or economic interest so as to avoid the economic risk of permanently divesting oneself of 11.58 million in wealth. Now, this is technically an option, but there are some pitfalls to keep in mind here. One, this could be abusive based on the way that this credit and the regulations are set up, even though the Treasury declined to include any anti-abuse provisions in the final regulations. Now, assuming that it's not abusive, you have to be careful about the level of control that's retained by the grantor in this case. For example, the grantor probably couldn't be the trustee of a trust, allowing the grantor to receive income, because if that power as trustee is not sufficiently limited, it could keep there from being a completed gift. And if there's no completed gift, there's no gift tax, and thus no use of the exclusion, which completely nullifies the reason for funding this type of trust. And it's also important to take into account the effect of Code Section 2702. Now, 2702 was geared towards the opposite end of this spectrum. It was designed to prevent a grantor from overvaluing a retained interest in a trust for gift tax purposes. But in this case, really what you're doing is if you create a trust, put 11.58 million into it, and retain an interest, you can't be taxed on a gift to yourself. So the risk here is that really the grantor could be undervaluing a gift to himself or herself. And Code Section 2702, the spirit of it, could also kick in to address that situation and prevent a full use of the exclusion amount for that gift itself. Thanks again, everybody, for listening to this episode of the 10th of an Hour. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. Thanks again for listening, and I look forward to seeing you in the next episode.